Hi everyone, my name is Darryl Payne, CEO at As Good as Gold Australia, and this evening I'm here with my brother Brian and partner at As Good as Gold. And tonight we have a very special guest, none other than the author of the Silver Manifesto and The Second Chance, both great reads. He is a keynote speaker at investment conferences all around the world. He is the publisher of the Morgan Report and is recognized globally as the Silver Guru. Welcome, David Morgan.
As Good as Gold Australia is now open for business in the US, and to celebrate our launch, we're offering our new clients for the month of July the best price Sunshine Mint 1 ounce Silver Eagle rounds in the United States of America. So what we're saying is that you are welcome to draw a comparison with any alternative supplier in the country. As long as our stock lasts, you'll find that we have the most competitively priced silver available with the ever popular Sunshine Mint 1 ounce silver round. Any quantity from 20 to 1,000 ounces. It's the same price and in most cases dispatched within 48 hours from receipt of payment. So take a look at the video description below and go ahead and click on the link, which will take you to the silver sale on our website. But remember, this offer is only available until the end of July. The best price silver sale in the US right now. So what are you waiting for? Take advantage of this sensational offer today.
Well, Darryl and Brian, thank you very much for having me. It's a pleasure to be with you remotely. I love being in Australia, but this is a little less flying time.
Well, we did catch up in would have been November last year, of course, in Melbourne at the Gold Symposium. And I remember when I was there, I always wanted to ask you the question as to how you got involved in precious metals. So I thought, seeing I didn't ask you the question then, I'd really like to do so now. And also, I'm intrigued by the Silver Guru label, and I can pretty much understand how that would have developed, but I'd love you to share that with us as well, if you could.
Sure. Well, the long story is in my first book, Get the Skinny on Silver Investing, but the monetary coinage changed in the United States in 1965. I was 11 years old, and I took note of that. I didn't jump up and down and say I'm the Silver Guru, or didn't even know exactly what it meant, but it was just innate knowledge that if you looked at a copper coated coin that was copper coated with zinc, and we call it cupro-nickel, or maybe some nickel in it, and then a silver, 90% silver coin, it's just well, silver's got to be worth more than this copper thing over here. But like I said, no adults, so that kind of planted the seed.
Right.
And I was just fascinated by money for whatever reason. So at a very early age, I started investigating, money and banking. And I learned very early on about fractional reserve banking, and that didn't sit right with me either, because I thought, well, that gives this one group an advantage over everybody else, because they can basically take your money in and loan it at about a 10-to-1 ratio. And God, why, I'd like to do that. I mean, this is a good. I didn't call it a racket. I didn't probably have that vocabulary, but anyway, so that kind of started the quest. And then as far as the Silver Guru is concerned, I mean, I just added that kind of, if you go back in time, and this is just, me thinking, I want the internet. I was a very, very early adopter of the internet. So I just wanted some kind of a moniker or a label or recognition or something that people could find me. But I did it pretty much tongue in cheek, and, it stuck. And of course, there's people that take that label very seriously. I was at an investment conference, one of the first ones I did in the early 2000s at a wealth protection conference in Arizona. And the promoter asked me a question that he had asked literally maybe 40 or 50 others over the years, because each event had maybe 5, 6, 7 speakers. So we're not talking over 50 years, talking over 5 or 6 years. He asked everybody this particular question, and I answered it, and he goes, "Oh, you are the Silver Guru." So anyway, it all depends on your perspective, but I don't take it that seriously.
Right. Actually, it's interesting because I had to wait until I was into my mid-40s before I really started to gain an understanding of precious metals. I met a gentleman by the name of Peter Daniels Sr., who became my lifetime mentor, but he educated me on the difference between currency and money. And I sat there in awe as he described this to me, and I thought, what have I been missing out on? But from that moment onwards, I just engulfed, as did Brian, we engulfed ourselves in the subject of global monetary history and really understanding the role that gold and silver play in the monetary system. So I'm a little bit jealous of you that it all took place a little earlier. I would have loved for the same to have happened to us. However, I did get the message. I was fortunate that I came across someone who spent some time with me. But what I would like to do, and I'm going to show everybody this book again. If you don't have this book, guys, you need to get a copy of this. It's just an absolute great read. There's some information. What I want to do, David, is refer, if I could, to the back cover and just make reference to something that you've said here, read the second chance. And if I can just quote this directly, it says, did you miss the gold and silver spike runs to $1,950 in 2011? Did you get in near the top and ride them all the way into the December 2015 lows? Or perhaps you didn't buy at all. And by late 2016, while the most explosive precious metals and mining stock run up in decades was taking place, you watched. You may think you missed the boat, but you would be wrong. Second chance, how to make and keep your money from the coming gold and silver shock empowers you to step into the investment battlefield and leave it a winner. Many people will make fortunes during the coming years on paper, but when all is said and done, as the great speculator Jesse Livermore stated, on paper it will remain. In your hand is information that can help you stake a claim to a seat at the winner's table. When the historic bull run is over, do not miss your second chance to make it and keep big money from the coming gold and silver shockwave. David, if you could just expand on that a little bit, I'd really appreciate it. What do people need to do to take advantage of this oncoming bull run?
Well, what they need to do is take advantage of the low prices we have right now. I mean, if you have just silver on a currency basis, it's as low as it's ever been. Now, people are going to say, well, wait a minute, David, in your lifetime, you said the lowest price inflation adjusted silver's ever been was under the $5 level when Warren Buffett bought. That on an inflation adjusted basis was lower than the 25 cents during the Great Depression. So $5 is a lot higher than 22 cents. But that's just a number. We're talking about how many pieces of paper versus 1 ounce of silver are out there in the in the world. And so that's the actual low. And right now we're basically at a similar point with $16 silver. There's been that much printing of paper that has not filtered into the mainstream. It's only gone basically to Wall Street and the banks, and that's why the stock market's so high and the bond market continues to do well. So right now is the time to take advantage of it. And I'm going to anticipate you have another question, and that is, how do I know? And this is very difficult. Fundamentally, the precious metals historically have always done what Mike Maloney calls an accounting, which means that they get to be equal to the amount of paper printed. And I've done article after article on this. You can look up Engineering the Price of Gold, David Morgan, put it in the search engine and read that article from over a decade ago. But what it basically says is what I just stated, is that if you account for the M1, the pieces of paper versus the amount of gold, you come out with a paper price, which is around, depending on the numbers and what method you use, it's a very simple arithmetic problem, around the $10,000, $13,000 per ounce. So that'll give you a flavor for how much paper's been printed. And through most of history, the metals make that goal, in other words, make that level. In 1980, it would have been $400 or 400 pieces of paper equaled 1 unit or 1 ounce of gold. The price went to over 800. So in my article, Engineering the Price of Gold, I suggested that in a mania, panic, a fear of the currency breaking down, that that the market could overshoot. All markets are either undervalued, fair valued, or overvalued. And I think it's ridiculous to think, with the problems that the global economy and the global currency markets face, to think that once we get to this next bull leg up, that we're going to stop at fair value. I mean, I really believe we're going to go overvalue, probably extremely overvalued.
Right.
So that's the fundamental case. On the technical case, all markets move in basically threes. I'm not a big Elliott wave guy. I know the basics of it. I have friends that, you know, can tell you everything about Elliott. But we've had 2 legs up, and we have 1 to go. Now I was in, I forget, Europe somewhere. No, I was actually in Australia. And one of the other speakers was in the audience, kind of hanging on my every word. And I made that statement. He didn't argue with me. He suggested that we've only had 1 leg. We've got 2 to go. I'm not going to argue. I know we have at least 1 ahead of us. I think it's the last one. He could think there's another one. That's fine with me. But we've got a big move ahead of us.
Yeah. So how far away do you, what's your expectation now? I mean, when do you think we're going to see a move?
Yeah, I'll interrupt you. It's going to be a while, and not a real while. First of all, the 3rd leg is the most powerful leg as far as price appreciation. Yep. It is not the longest leg. In fact, it's usually one of the shorter legs. So if you count the bull market from 2000 for gold, and there's usually a 17-year bull market as average, you could say, well, you know, maybe 2020, 2022, somewhere in that, which is about what I forecast. Gold, silver didn't really break out until September 2003. So if you use silver, you would say 17 years to be 2020, and add a couple of years, 2022. So I'm thinking probably the next 5 years. But what happens is, once we get above, say, and this is not a magic formula, but it's all based on momentum and change of psychology. And where is that on a chart? And the answer is nobody knows. But what I do know from 40 years in the markets, not just in the metals markets, once we get, let's say, above $22 silver U.S. terms, and we get above $1,450, $1,500 gold, we're getting those levels. All the psychology that's been negative for 6 long years will turn positive again. And all of a sudden the momentum will start. So then you'll get gold back to 2000, it broke 1900. And then you'll get another wave in. And that will continue to build momentum. People love buying high-priced metals. Believe me, I know. And so we'll see this feed on itself. And then you're just going to see an acceleration like you saw in the 2011 markets, like you've seen in the housing market, like you see in the tech wreck, like you've seen in all these markets. So you'll see it again in the metals, except this time, if, and I believe strongly it will occur, you'll see a lot of news that will be very indicative of why you want to be in the metals, like a liquidity squeeze. It's hard to sell your housing, but you can, buy metals. Basically, nothing's going to be working at that time. I'll say nothing, but very little outside of the precious metals. So there'll be a big push into the metals, and there's very little precious metal versus the amount of paper that's floating around in other asset classes. So when just 1%, 2%, 3% of that money that's in real estate trust or in the stock market or in ETFs or whatever decides, I need gold, I need silver, it's going to be a really big move.
What an opportunity, though. I mean, I get so many people who say, Darryl, when's it going to take off? And I say, look, the most important thing is you probably haven't got enough. I mean, there's a wonderful opportunity. If you can take off, but if you've only got 50 ounces of silver, you're not going to benefit a lot from that. But this is a wonderful opportunity for all of us just to keep adding to our supplies. And that's what Brian and I have been doing for the last 10 years. We just keep adding to our supplies all of the time. So when it takes off, and that's not too far away, we'll like a good friend of mine, Peter Daniels, I've mentioned him earlier this evening, but he said, Darryl, it doesn't matter what happens to the economy tonight, I'll still be able to party tomorrow, because he has reserves. He's got real metal in his hands. Yeah. Brian.
Yes, good morning, David. Just before I ask the question, I noticed you have a German Shepherd by your door. Let me tell you a funny story. We've got a 11-month-old German Shepherd, still a puppy, female, and if she was like the one you've got, I'd be very happy. But this one is still being under training and would jump all over you. Yeah, so congratulations, you've got a very well-educated German Shepherd. To the questions, and I have two at this stage. There are many authors that write about how much physical silver that JP Morgan has bought over the last decade. And I think that Ted Butler is probably the closest. Could you give us your feelings and maybe discuss what their intentions are? I mean, JP Morgan's intentions.
Right. Well, first of all, I respectfully don't think that JP Morgan has like the 600 or 700 million physical that Butler claims. He's really not able to prove it. And, you know, I mean, I was one of the first to really meet Ted, you know, when Ted was writing on the internet, and of course he still does. First of all, what we can prove is what JP Morgan has, and that's, and the last time I checked, the numbers changed somewhat, I'm sure, but that's 135 million ounces. And of that 135 million ounces, about 90% of that is what's called the eligible category, which means those are long-term investors that own that silver, not necessarily JP Morgan. They might have some in the eligible category, but it's doubtful they have any. But you could even say that they have some, but most of it's held by other entities. So the remaining 10% or so is what JP Morgan actually owns in what's called the registered category, which is their dealer inventory. Now, as far as, you know, they have bought all this silver, it's interesting that I've had multiple calls with multiple entities, and I'll keep their anonymity because I think they want it to be kept. So I'm going to make that presupposition. But one of these entities is, and you can probably figure it out because there aren't many, this is a COMEX approved warehouse. And I know the CEO quite well. And in fact, his next in command, his president of the company, when I was visiting their facility years ago, told me that JP Morgan was putting a facility together for silver storage in Asia. I thought, wow, that's interesting. Of course, these guys are really on the inside track. Not that I'm not, but you know, it was news to me. Mm-hmm. But having said that, I actually spoke to that same individual very recently on this exact topic. And let's just say that there's a bunch of eagles out there and JP Morgan buys up all these monster boxes and then smelts them down and puts them into commercial bars. Well, what would happen is that someone like me or someone bigger than me, or, you know, would come in to any dealer anywhere in the world and say, you know, I want 6 monster boxes of 2015 eagles. And what would happen is that there would be a very limited supply because it had all been melted down and put in the commercial bars. Mm-hmm. So it would be obvious to the dealer market. You guys would know instantly that what's going on here. The minted, you know, I don't know the mint numbers that year, but we'll say 35 million eagles. And yet it seems like the best sources we can find, there's only like 5 million floating around, or 2 million or whatever. That would be readily apparent. The other thing is, it's hard to believe that they would give up a premium on a coin like that. I mean, you already got $1, you know, 25, 35 to the dealers that can buy directly from the mint that have to be approved by the mint in order to buy at that level. When they buy at $1.25 over spot, they don't sell it for that. They sell it for more than that. They have to make a profit. So it'd be hard to believe that they would do that. And then you would have, you know, the silver being trucked around. I mean, you can't keep that kind of a secret, in my view, very easily, because, you know, some refiner somewhere is going to say, wait a minute, we just shipped a bunch of eagles out of that door, but now we're bringing them in and we're cutting them back down in this door. I just don't, it just does not make sense. Most was stuff I discussed with this individual, also with another well-known coin dealer friend of mine that brought up the topic and said that, you know, he believed Butler and used it in his lecture. Certainly wasn't going to pop his bubble in front of the other attendees. And I'm not 100% sure I'm right, but I've thought this through. I just don't see it. So, so that's my take on it. And another thing, if you took off 600 million ounces of physical, I don't care how much paper you throw at it, it would show up in the price. you wouldn't be at $16 silver. You're off taking that much physical. You just couldn't. I don't care how much paper you throw. I mean, you look at what happened between, you know, the last big move in silver, where we went from 19 up to 48. I mean, near the end there, they were throwing a ton of paper at it, and it still wasn't suppressing the price. And the exchange had to come in and increase margin requirements like 4 times. So you cannot, you know, I mean, I've never seen a market where you took off that much physical. I think Butler and I agree on a lot of things. And one of them is the physical demand is going to move the price. So, you know, so that's it. I don't want to belabor it. I haven't done this publicly. I prefer not to, but you asked the question. That's my view. And we'll just leave it at that.
Okay. Not a problem, David. That's a good answer. Question number 2. Now, I recently viewed your interview with Jeff Christian and was surprised to hear that from 1968 to now, the best portfolio to have requires 27 to 30% precious metals, as well as gold and silver mining shares. Now, in Jim Rickard's book, The Road to Ruin, where he writes that one of the wealthiest families' advice was to own 1/3 land, 1/3 precious metals, and 1/3 fine art. What are your findings, and do you believe that we are seeing an increase from the 10% rule?
Yes, well, I'm not sure exactly, Brian, if you're referring to my 10% rule in the Investing Rules book, the 10 Rules of Silver Investing. The last rule in that write-up was, you know, too much of a good thing is too much of a good thing. I suggest 10%. It wasn't too long after that where I publicly declared at an investment conference in San Francisco that I was increasing that to 20% because I saw the Iraq war coming to the fore, and of course it did. So I've kind of been in the 10 to 20% rule. So if that's that part of the question, I've answered it. And as far as Rickards goes, he's right. The only you know, addition I'll make to that is, you know, at the level he's talking about, most of us are not in the fine art category. So you're pretty much left to, you know, real estate and precious.
Isn't that a Picasso? Isn't that a Picasso? Yeah. I see that behind you.
I've got a print, I think 249. So it's got a 49 in it, which I think probably worth a little bit more. But no, I'm not a fine art collector. But he does make sense. I mean, he's right about it.
Yeah, absolutely.
That's for the pretty much the elite class.
Over to you, Darryl.
Yeah, sure. David, look, Jim Rickards, we've referred to Jim Rickards, and he's not on his own, but there is a continual reference here to this looming Black Swan event, one of which will trigger the economic collapse. I'd ask you, could it be an ongoing war in Syria? Could it be Donald Trump instigated trade wars? Could it be the Petro-UN? Could it be a stock market collapse? Could it be interest rate increases or a major default from a country like Greece, Italy, Turkey, or maybe a bank typically like Deutsche Bank we know is in considerable trouble? Could it be all of them? What are your thoughts? What do you think is going to trigger this event?
Well, I think you named several that could. And my metaphor, analogy for that, I think I took this from Ned Neeler Leyland, but there's so many black swans flying around, which you named several, that when one smacks into the other, away we go. Sort of like the domino effect. You know, one domino hits 2, that hits 4, that hits 8, that hits 16. I think that's probably a cascading event that we're probably going to see. So it could be just a rumor that Deutsche Bank you know, it's going to fold and the stock price goes down $2 more in a day, and actually it doesn't. But that trigger that you can see in the stock market causes a big bond sell-off, and that big bond sell-off causes an equity sell-off, and on it goes. So we're in a very precarious place. Most people are unaware of it. Most people think the problem's been solved. It's never been solved in my studied view since 2008. So I don't think we can pick one, but I think we can see several are flying around, and that once one whacks another one, we're probably on our way.
Yeah, as Jim would say, it's a snowflake, isn't it? That's all it needs. It's the last snowflake that creates the avalanche. Yeah, and Brian.
Yeah, David, last question from me. Look, using the quote from the original JP Morgan, gold is money and everything else is credit. Is there a limit to saving, in your opinion, in gold and silver, or do you wait until you see the right investment and use a proportion of your precious metals to purchase a good investment that is on special?
Yeah, I don't believe in all metal. I'm overweighted. I'm more than 20%. A lot of my precious metals and resource investing stocks. By the way, I just want to plug the Morgan Report real briefly, but I want people to know it's not about gold and silver only. Of course, we spend a lot of time there, also on the global economy. But we've made money in Mali, we've made money in tech stocks, we've made money in like coal, we've made money in copper, lithium, rare earth elements. We're first on the cobalt story. So we look at all resources. Coming back to your question, yes, if there's a distressed situation, maybe in real estate or whatever, I've never bought a business, but yeah, there are opportunities. In fact, one opportunity I had recently was a guy that wanted to buy a piece of real estate that was very undervalued. He didn't want to cash out his silver. So I did a bridge loan for him, used his silver as collateral, loaned him the money. And then I took a nice hefty 10% fee, which, we agreed to ahead of time, of course, in silver. So, I put my cash to work and that type of thing. Coming back to the stocks, I didn't finish saying was a lot of these equities where I've done very well. I cashed those out and put it into physical metal. So I try to balance between the equity position and the physical metal position, but you make so much more money in paper silver. I know you guys are coin dealers and and I've always been consistent here. Let me be consistent again. You've got to start with real metal. I mean, if you don't have physical silver and gold, or at least physical silver, I really don't want to talk to you. I don't want your subscription to the Morgan Report. I want basically anything to do with you, because you can't have protection or be a precious metals investor unless you have precious metals. Once that's accomplished, if you're ready to go up to the next level of risk and reward and you want to get leverage into this sector, you got to, know what the heck you're doing. Yeah. And if you don't, you should get some advice from somebody that does. And then you can make a lot more money in the paper market than you can in the physical market. But you can also lose in the paper market, again, unless you know what you're doing. So back to you guys. That was a great question. Thank you.
Yeah, I agree with everything you're saying. So yeah, thank you for your answer.
David, just recently, we engaged with an Australian economist by the name of John Adams. He wrote an editorial on the 10 signs leading to Australia's economic Armageddon. Now, John was focusing on Australia, but the signs he refers to are not limited to Australia. This is very much a global issue. So what I thought I'd like to do, and by the way, this gentleman was an advisor to the Australian Liberal Coalition Party. So he's a very qualified economist. But I'd like to list the 10 signs, if I could, and ask you for some feedback. If you just give us a little bit of feedback on each one, if you could. So he referred to sign 1, record Australian household debt. I have no doubt that the same situation would apply in the United States of America and many of the Western countries in the world. So he sees that as a major sign. What are your thoughts?
Well, I agree. It's pretty much pervasive around the globe. Most people that, buy now, pay later. So it's based on credit. And lately, meaning the last years, probably 5 or so, you can't put an exact number on it. People have actually used their debt or their credit to purchase necessities, because there's been a downgrading of the middle class across the board. So people that have lost their jobs that were paying, excuse me, X amount are lucky to get a job that pays 80% of X now. So they've, to keep their lifestyle, which at one time they could easily afford, now they can't. So this is a very sad situation, but borrower is a slave to the lender, and so you want to be careful. But I realize why it's happening, and it's again the sign of the times.
Yeah. He lists sign 2 as falling Australian household savings. I know that when I was a kid, I had a piggy bank and I had a bank book, and I was thrilled that I could look at that bank book and see my investment growing. Kids don't even know what a piggy bank looks like today, and nor do they, in fact, have a savings account. And as we all know, of course, governments around the world want us to spend, so we get rewarded for spending, it should be the other way around, rewarded for savings. Once again, would you like to comment on that?
Yeah, it goes right along with number one. I mean, basically in capital formation in a real free market, which we really don't have, it's based on accumulated capital, which means you've saved. And the people are unable to most of the time now, but it's definitely a sign of the times again that we're in a situation that we can't, really get out of.
Yeah. Continued record, sign 3, continued record low Australian interest rates.
Well, this is financial repression, where basically the government has its thumb on interest rates, because in a true free market, it is commensurate with the amount of risk that is entailed with holding that asset or that debt. So if there's a high probability that the debt won't be paid back, or an almost guarantee that it won't be paid back in the same terms, meaning that the units of credit will be equal to the units of credit that were loaned. In other words, over time, there'll be depreciation of the currency, whatever that debt is issued in, be it Australian dollars, US dollars, Canadian dollars, or whatever. Then there'll be a higher interest rate because you've got this risk of currency devaluation, risk that it may not be paid back. And so it'd be far higher, but the governments basically are able at this point in time to keep those interest rates very low, to keep this financial repression going, to keep the whole system together with bubble gum and baling wire. At some point, and I think we're getting very close, we'll start to see interest rates get out of their control, because the market will actually demand a higher interest rate for the higher risk.
Sign 5, David, continued increase in global debt.
Well, everyone says it, from myself to Jim Rickards to Bill Holter to anybody in this genre, anyone in this precious metal space. I mean, you can't solve a debt problem with more debt, and that continues to go on. So all we're doing is what I said in the previous question: we're increasing the amount that cannot be paid back, and at some point the market will recognize this is ridiculous. It can't be paid back, and that will be reflected in the interest rates. And what that means is that the bond prices will start to come down.
Yeah.
And once the bond market starts to fall, readjust, you'll start to see a lot of things shift around, because the debt markets are much bigger than the equity markets. So it will affect everything, because everything's based on debt, and the debt's unpayable. So again, once you see this exit from the door, and you've really seen the exit in a way, because if you look at what China and Russia are doing, first of all, they're sick of the treasuries that they have. They pretty much stopped buying them, and they're, offing them slowly and surely, so there's a market for them. And you basically have the buyer of last resort being the Fed. But when the Fed has to be the last buyer to buy the debt, then what does that do? It creates money. It goes from a long-term instrument like 30-year bond into a cash instrument. It says you've paid it off, which means that $1,000 or that 10 or 100 or million or billion or billions turns into cash. Now you're sitting on cash as the person that sold the bond. What do you do with it? Well, usually you put it long-term because it's savings. So now you've got this money that you've got to redeploy. I mean, yeah, you could buy another yacht or another plane or whatever, but you're probably going to look for a place to park it. Well, where's that money going to go? Well, let me suggest that it's just 3 or 4% goes into the precious metals. That market is going to really explode. And that's why I'm still a man of conviction about the precious metals' greatest move lies ahead of us.
Yeah. Wow. Okay, he refers to sign 6 as major international asset bubbles keep growing.
Yeah, that's a sign of what I just said. Basically, with all this money printing that goes to the elites, goes to the banking sector, goes to Wall Street and the equivalents around the world, there's no place to park it other than basically the equity markets. And so that's where the money keeps flowing. And it will continue to do so until it doesn't. I know that's a corny answer, but it's exactly the truth. So, the stock market in the U.S., I just did my weekly perspective and said, we just got another, new high, looking toward new highs in the stock market. Stock market technically looks very robust right now, so it could keep going, but we just keep going until we don't. In the meantime, gold is held its 2-year uptrend and continues to look strong, and the underlying equities are showing signs of strength. So I think we're at that inflection point finally, where we're going to see that the 2015 low I referenced at the back of the second chance book is true, still holding. And we're going to be a subtle, stealthy kind of a market in gold for a while, where no one's really paying much attention till it gets to, as I said earlier in the interview, you know, that $1,450, $1,500 level. Then all of a sudden, everyone gets just the my, how did gold get to 1,550? I thought it was at 1,200. And then you'll start to see a lot more money come in. You'll see money come in to move it up higher as we speak. But the real, you know, the people that left the market coming back into the market, you won't see that until you see a few $100s higher in the gold price.
Right. He refers to sign 7, increasing inflation, and makes reference to oil prices and just the oil price adjustment there over the last few months, up around 40%.
Yeah. So everything runs on energy. Everyone thinks it runs on finance and money, and you can make that argument that the truth is without energy, nothing happens.
Yeah.
Silver and oil are very highly correlated. So we're seeing an increase in oil prices, which gives us a pretty big hint that silver is overdue to start rallying up. And this is a sure sign. Without energy, nothing happens. I just repeated myself, and that means that we are seeing inflation. It trickles down onto everything.
Yes.
Transportation, communication, production, food, everything.
Sign 8, tightening monetary policy and rising global interest rates.
Yeah, this one's a tough call as far as is it by design or not. I suggest it's probably by design that the central bankers, you know, if they tighten up monetary policy and force interest rates higher, that puts greater pressure on the markets. And of course, it's going to cause, you know, greater financial instability. And, you know, do they want it or not? I suspect that they may, you know, be doing it deliberately. I mean, as we talked about, interest rates are going to go higher regardless of what the central bankers want or don't want, because once the market forces take over, they don't have a lot of control.
Right. Interesting what he did mention, David, is that rejection on mortgages over the last 5 years in Australia, mortgage applications has been around 5%. In May of this year, it leapt to 40% rejection rate. So it's outstanding. And I was speaking with a financial a gentleman the other day in the finance industry, and he said, Darryl, they are just tightening. Business loans are really almost impossible to gain at the moment. And he said, now it's flowing through to the housing industry. So obviously that would just have a huge impact on the economy. And so I think we're starting to see those signs now. Sign 9, inverted and flattening yield curves. As it's been explained to me, they are a very strong indicator of an economic downturn. What are your thoughts there?
Yeah, absolutely. It's almost a guarantee.
Yeah.
And, you know, why would you loan your money for 30 years at, you know, 3% when you can get a T-bill at 3.5%? That's an inverted yield curve.
Yeah.
So when that happens, and that's just a number, I just do it to make sure everyone understands what it means, that obviously all that money starts coming out of the long bond and into the short term, because you've got, you know, higher interest rates for a lot less risk, because you're only risking your money for a matter of months instead of, you know, 3 decades. So this is a huge problem facing, you know, the global empire, and they know it. So it's going to be interesting to see. And this next one, I think, is one that we're not going to be bailed out of. It may be a question of being bailed in, or a question of, as Jim Rickards says, you know, going to another currency system like the SDR or something along those lines. I don't want to go into that discussion right now, but I just want to put it out there for people to think of.
Finally, David, he lists sign 10 at return of risky derivatives, a repeat of 2007-8. Of course, the global financial crisis happening all over again.
Absolutely. I mean, the only reference I can give here is to go to a search engine and type in the Exter pyramid, EXTER pyramid, and look at the liquidity squeeze that John Exter talked about years and years ago. And what this means is that the riskiest asset class is the most worthless and the most illiquid. and that's the derivatives market. And this thing is such a mess that when this pyramid starts to take place, meaning that people scramble to get something they trust, it's all based on confidence and trust.
Yes, it is.
So once people start worrying about the bond market, well, almost all your derivatives are based on interest rates. And for every winner, there's a loser. The problem is that we learned in 2008, for every winner, there's a loser, except they can't be paid back because everybody's illiquid. So what happens is the major banks came in and solved the problem temporarily and said, well, AIG backed up most of these derivatives with insurance, so we'll make AIG whole. We'll print money out of thin air. We'll give it to AIG so they could give the winners of the derivatives their money. Well, this is totally fake, phony, and false. Should have never been done in a free market. The right to succeed guarantees the right to fail, and everything that should have failed should have failed. Now, I sound very hard and harsh about it, and is that what I really wanted? And the answer is probably not. As much as academic, Austrian, real guy, whatever term you want to put on me, I don't care. The point is, it's a really tough call if you really look at it objectively, which means had we let the free market take over and all those banks would have failed and on and on. No one knows what the outcome might have been. However, I suggest that whatever that outcome might have been, as harsh as it could have been and as devastating to almost all of us as it would have been, it would be less harsh than what's going to happen the next time.
Next time around.
So looking at it from this perspective now, I'm thinking, we should have let the free market work its magic and let all this crap go to where it needs to be adjusted to.
Yeah.
Instead of the central bank taking all of this CRAP crap onto their balance sheet, monetizing it into pieces of paper, theoretically, and giving it out to these losers, rewarding these losers. When in free market capitalism do you reward a loser? You don't. It never happens. You're not supposed to let it happen. So, I'm an advocate of the best for everybody, everywhere, at all times. And we don't have that anymore. We used to have it, or close to it, but not now. So I know the left really is, anti-capitalism and blah, blah, blah. It's not working. Well, the system isn't working. But folks, please do enough study to form an educated opinion. It's not capitalism that's failing. It's the system that's failing, which is kind of a hybrid mess of the elites running the credit system for everybody's benefit, meaning nobody's benefit except their benefit.
Yeah. David, thank you for that. I'd like to finish with this, The Second Chance. This is a great read. I've read it a couple of times, and what I'd like to do is refer once again to the rear cover of The Second Chance. Read your comment avoiding the amateur's mindset. As underprepared as Australians and the rest of the world would appear to be, they still have time based on the information in your book. You refer to 90% of the profit potential for metals and mining stocks becoming available during the last 10% of the entire bull run. Could you just, and I've seen it work, but I'd just like you to expand on that if you could.
Sure, 90% of the move comes the last 10% of the time. If you do the math from for the last bull market that I participated in, basically silver went from the monetary value of $1.29 an ounce up to $50, but it went from $1.29 in 1965 or 64 up to about $6 in the start of 1979, and in the end of 1980s at $50. So you got an 8-fold move in 1 year. That whole market move was about 16 years. So that's kind of proof that it happened in the past, but that doesn't prove the future, and we all know that. But if we look at what happened in the housing market, or what happened in the Dow when the Dow made its big tech wreck move, or the NASDAQ in 2000, I mean, that market was going, parabolic, totally vertical or near vertical, and everyone said that's it. It went up again another 100%. So those are the type of moves that you see not just in the metals, you see it in real estate, you see it in the stock market. So it's typical market behavior, and this time I think it'll be driven by two things: panic, so it'll be driven by fear that a dollar's not going to be worth anything, and I got to get out of it, and where do I go? And also probably greed. So you're going to have greed and fear probably working at the same time. So It could be, and nothing drives a market more than fear. I mean, greed will drive a market, but nothing drives it like fear. I mean, people think that their life savings are going to be wiped out, or that the currency of wherever they're domiciled is going to become worthless or is losing such value that they rather own a jar of peanut butter than an Aussie dollar. When that happens, then you're going to get in this big, huge rush. And, you know, right now, and I want to comment on this, I think it was question 6 about, you know, everyone's been, in my view, my opinion, I'll get the hate mail or you'll get it, you know, the real estate aficionados. Everyone knows real estate's real property, and there's a lot to be said about real estate. And I agree with Rickard, you should own it, but at the right price.
Yes.
So as much as there's a mantra globally that real estate's a good investment, after this next move in the metals, it'll be the same mindset for the metals. It's like, wow, you never lose in the long run if you own precious metals. And of course, there's a time to buy, a time to reap, and a time to sow.
Of course. Of course.
And back to the second chance. The main thing I don't want to see happen is people get married to the metals. I mean, there will be a time when silver and gold are overvalued, and at that time, you should lighten your load. You should take advantage of that and look for, as Brian said, where do you put your money? Well, maybe it's real estate, maybe it's raw land, maybe it's a business, maybe it's the stock market, maybe it's, you know, a cryptocurrency. I don't know at this time, but what I do know is when something's extremely overvalued, you better be looking for something that's undervalued or extremely undervalued to make that, you know, to make that switch.
Yeah, yeah. It could be the advantage, I mean, of, and we get asked the question all of the time, of course, with reference to silver. Should I buy 10-ounce bars? Should I buy kilo bars? Should I buy 5 kilo bars? I tend to buy a lot of coins personally because it gives me a much better chance of getting a better sale price, average sale price on my coins. I would have hate to have been in a position in 1973 and having had maybe 10 5 kilo bars of silver, sold them all off in 74, 75 because I doubled my money, only to see silver go for a rip from there through to 1980. So how do you feel about that?
I basically teach that, you know, unless you're really well heeled, basically just stick to coins.
Yes.
But if you're in, you know, a high category, I mean, it's pretty hard to stack coins. I mean, those monster boxes take a lot more space. So, go to bars. So I have both. You know, I mean, bars
yes, of course. Yes.
Stack and that, and you know, but beginners definitely start with coins, and for most people, coins is the way to go, and for the reasons you outlined.
Yeah, yeah. David, look, I would like to thank you so much for your input this evening. It's been fantastic. And if any one of our viewers, and I'm sure there are many, would like to take advantage of your undoubted knowledge in this area and maybe subscribe to the Morgan Report, what would be their best approach?
Well, just go to the main website, themorganreport.com, all one word, and get on our free email list first. You'll get a weekly perspective from me every week, and I do probably 2 or 3 interviews a week still. And we produce those and send them out to our email list. And then if you're interested in, as a serious investor in the resource sector across the board, we just put out a report on how to invest in cobalt. The stock is around $8 right now. One of the bank analysts predicts it's a $22.50 stock. And that's just a projection, no guarantee, but, you know, caveat. But that shows you, we try to find value in that sector, and we've done it time and time again. Do we get it 100% of the time? No, no one does. Anyone that tells you they do, run. But we do quite well, and our equity positions have done well. One of our trading positions was around the $6 level, and it went to $5, and we got stopped out, and we got back on it, and now it's at $8. And that stock was at $6 when silver was substantially higher than it is now. But that shows the kind of leverage in these stocks. However, timing is key on a lot of these, you know, on a trade. We do both trading and investing. It's geared for investors more than traders, but we do both.
Fantastic. Well, I hope for well that our viewers take full advantage of that. I expect they will. I would like to thank you again, David, so much for your input this evening. It's been fantastic catching up again. And we would love to do this again in the foreseeable future. It would be just terrific to be able to catch up again as we watch the silver and gold, of course, progress, and just see what happens to the economy over the next few months. But love to catch up again. know you're a busy man. Appreciate your time and effort so much, and we would look forward to our next interview with you. Thank you so much. And to all of our viewers, of course, thank you so much, and we look forward to catching up with you very soon.
Thank you, David.
Oh, Brian.
Thanks, David.